welcome to NDTV Profit. You're watching the Portfolio Manager, and my guest today is Venugopal Manghat, who is the CIO Equity at HSBC Mutual Fund. Venu, thank you very much for joining us on NDTV Profit. To begin with, Venu, you manage nearly 42,000 crores in asset under management. A bulk of that is into multi-cap and small cap and mid-cap. Tell me how you are allocating your, funds today between mid-cap, small cap, and the large cap.
I think it basically depends on the opportunities that are there and the objective of the scheme as well. You have opportunities on all three sides of the market. I think on the large cap front, there is a lot of sector rotation that is playing out. So you can get ideas from different sectors and plug in gaps which are there. So that's one. Mid and small caps are more bottom-up stock picks, and we always look for ideas and to identify new stocks for the portfolio. So that's a constant process, and there's been a large number of stocks that we've unearthed over the last so many years, and that's given us the alpha. I believe it's investing outside the benchmark, looking at the broader markets that give you the edge over the benchmark and competition in general. So has been our forte, and that's helped so far.
How do you manage the entry and exits, especially in the small cap and the mid cap side? There is a liquidity issue which comes into play, because of the price volatility that may come into these stocks. So, between small cap and mid cap, you have small cap concentration of nearly 35% for your multi cap, and mid cap around 26%, and large cap is at 35% for you. So, anything beyond the first 250 stocks as per classification comes under small cap. So how do you look at liquidity? What is the parameters that you look to start investing in small caps?
Yeah, so liquidity is one of the more important aspects, given that anyways markets have moved up now, and you can get stuck if you are not in the right stock. So when we do our due diligence on companies, one of the first filters that we use is the management. Of course, the management quality, the business prospects, etc., are important, but also the liquidity that is there in the stock, the floating stock that is available, what you can do, what are the prospects over a longer period of time. So we believe that if the prospects are good for a business and for the company, and if it's run by good promoters, liquidity comes over time automatically. I think more and more investors get enticed into that company, into that stock over time because of the prospects, better execution, and the returns that the stock is giving. So it's important to get into the right businesses run by the right people. You have to keep in mind the liquidity, the floating stock that is there, but that is the additional factor. As the fund size has grown, especially on the small cap side, I've been conscious of keeping the cutoff in terms of what minimum market cap we will go for. Earlier, we used to invest in much smaller companies, sub 1,000 crore companies in terms of market caps. This was a few years ago. Now, since the size of the fund has grown, that has gone up quite substantially over the years. So now we really don't look for very small companies. We look for scale. And you asked about the entry and how do we manage that. So I typically buy stocks in small quantities, build the portfolio over time. So I don't like to really jump into a large position at in one go, unless it's of course a placement or you are part of a deal or a IPO or something which is fair. But otherwise, I like to if I'm buying from the secondary market, I like to build the portfolio over time. Assess how the market is looking at the stock, assess whether my thesis is playing out, and then get that conviction and then build the size of the bet that I would want eventually over time.
So if you look at the small cap and the mid cap space, the number of themes that are playing around are much more to play out, right? For the fund manager as compared to a large. Within the themes, how do you allocate funds then?
You're saying
if you look at the defense, it could be one theme. It could be consumer discretionary could be one, or cable and wires could be one, or a real estate allied sector, or auto allied sector, or auto ancillaries.
Sure. So when it comes to small and mid caps, it's largely bottom up in approach to investing. It cannot be that you want a certain allocation to a sector and therefore then you look for small companies within that. It's largely, how good the company is, how good the business is, how good the people are who are running the business, and then, take those bets. And, the final result is what you see on the fact sheet, which is the sector allocation that you get. Of course, larger sectors like IT and banking, etc., you would have that in mind as to, how much is the benchmark, what is it that you would want, how are what are the trends that you see in the sector, and what are the prospects going forward. So that plays in your mind, but generally it is, you get opportunities and then you build your portfolio, and as a result of that, you find the sector allocations changing. So it's not that, I need to allocate within the small caps into different parts of the market. The opportunities come in different parts of the market. And the beauty of this, as you rightly mentioned, the small and mid caps have a much broader, universe, I would say. Right from the 251st company up to, let's say, the 800th company. If you go by market cap, you have a 550 stock universe, which is very diverse in nature. I would say that has the best breadth in terms of sectors as well. A lot of new sectors as the economy is evolving and the markets are evolving. You're getting addition of a large number of new sectors and new kind of companies into the markets. So we've never seen some of these sectors getting listed, and now because they've got scale and the economy is evolving, we're getting those listed, and they're all coming in the mid and small caps. So it's a great place at the moment. I think there is a lot of variety there, much more than what you have in the large and the mid caps. Yeah.
I also see that you have a good amount of weightage to the IT sector. If I look at your multi-cap fund, it's around 12%, and small cap as well, 9% odd. What makes you so bullish on IT? Because in the IT has been underperforming, and many of the portfolio managers have reduced weight for IT. At that time, your weightage for IT is much higher.
Yeah, so like I earlier mentioned, it is largely bottom-up stock picking. So we have some of the small cap IT stocks, and some of them have migrated to a mid-cap range. Some have moved further into the upper end of the mid-cap range. But these have been early picks. Many of them have their own story, or all of them have their own story. They've come into the portfolios on their own merit. They are in niche segments, or they are having tailwinds of various kinds. Some have a change of leadership, which has played out for some time now. So each stock has a different story to tell. It's not that we've taken a sector call and allocated 9% within the portfolio. It's been bottom-up stock picking that has finally resulted in that allocation. We've not been very positive for some time on the large cap IT, the bellwether stocks that are there. We believe that it is a bottoming out phase that we see currently, but I think valuations are still not very attractive. Probably more attractive versus some of the mid caps, but yeah, it's still some time for the demand to really get better.
So within the IT, you also look at specific stories, basically that the reason being the engineering R&D story, which is there. You have exposure to KPIT and Birlasoft. If I see your portfolio, you are looking at differentiated offerings and new age offerings. Is that
Absolutely.
the way to look at it?
Yeah, absolutely. I wouldn't say new age, but differentiated, yes. Not really keen on the run-of-the-mill companies which are doing the same business. Then it's a call on what valuation you're entering and what valuation you exit at what price. That's not the game that we are interested in. We are looking at companies that can differentiate themselves and that differentiation gives them an edge for a relatively longer period of time. And we like to hold companies for long and remain patiently invested, and that's what we've been doing. So these are, you rightly said, it's a differentiated portfolio when it comes to the software side, IT side.
How do you decide when to churn your stock, especially when they have run up so much? Because that's a decision fund manager is always grappling with, right? Means in the last 12 to 18 months, you have seen small cap and mid cap run up so much. When to book profit and when to churn and when to keep this or hold these stocks?
Yeah, so I've been, generally having a low churn in my portfolio. So for the small cap fund, we have less than, I think, 0.3. So 0.2, 0.3 is the portfolio turnover, and that's been the case for the last several years now. Similarly with all my other funds. So it's not that I book profits on a regular basis and keep churning the portfolio or buying something new. Booking profits is a regular feature, but it doesn't necessarily mean that you completely sell out of stocks and get into new stocks, and that is the churn that I'm not very keen on. So when I'm constructing a portfolio, I would like to buy into companies where I can stay invested for as long as I can. That's the thought process. Now, there will be some cyclical bets within the portfolio which you will need to take a call at some point, or cases where valuations run up too much, where you need to be a little careful and wary, and maybe you need to bring down the exposure or exit the stock if you have something else to replace that. For long, we've held on to a large number of companies. The profit booking comes when you have, valuations having moved to unjustifiable levels. You book some profits, you reduce the exposure. At the same time, if you have something else where the returns can be better, if you think that returns can be higher in other portfolio stocks, then you tweak that and therefore increase the exposure there. So that's broadly what we've been doing. Not really changed the portfolio significantly, other than get some new stocks as and when you identify some great companies, then you add them to the portfolio.
And is there a trigger for the churn? So in the sense you spoke about what normally is your philosophy on churn, but is there a threshold of return after which you start looking at should I pay some of the profit, book profits or keep cash so that I can use it for other opportunities?
No, we don't use a threshold return to really decide when to churn. It's more case-to-case basis. If we feel that if the business prospects are going from good to bad to worse, then obviously you need to take a call and you will not keep a very high exposure, so you'll need to cut down on that. Or if there is any other issue that you have with the company, the business, then obviously you cut down your exposure. The third case is when valuations run up too much, which is the point I mentioned earlier, that then you pare down the exposure, and if you have something else that can take the place, then you do that. Those are 2 or 3 cases where we book profits and reduce our exposure. Of course, liquidity, the size of the company, finally, if let's say in cases, we've had cases where some small caps have gone to 5-6% by appreciation, then obviously, you can't take those kind of, at least I don't want the investors to face the risk of having that kind of portfolio where small companies are at 5, 6, 7% of the portfolio, and so that's a risk that I don't want to take. So to mitigate that, we reduce the exposure. So that's the other time when I want to really reduce the exposure or book profits.
Venu, stay with us. We'll come after a short break and we'll discuss more about some of his funds and his asset allocation across some of the sectors. Stay tuned to NDTV Profit. Welcome back. You're watching NDTV Profit, and this is the portfolio manager. And with me is Venugopal Manghat, who is the CIO equity at HSBC Mutual Fund. Venu, thank you for joining us. Let me take a view from you on some of the key sector allocations that you have made. You spoke about IT, software, where you are looking at some of them. But what about industrials, construction? How do you look at these sectors? Because there also you have a sizable amount of exposure in terms of holdings.
Absolutely. I think we have been positive on the industrial space for quite some time. I think one of the key drivers of the economy, we believe, is the investments theme that is playing out. The government spending on infrastructure and investments and the thrust to manufacturing in the country is really driving growth or giving opportunities for growth to a large number of companies. Many of these reside in the small and mid-cap space, and that's the beauty of the manufacturing segment. I mean, manufacturing, when I say, it covers a whole lot of sectors, ancillaries under that. So that largely resides in the mid and small cap range, and that's why we have more companies there in the small cap and the mid cap funds that we run. But otherwise also we are quite positive on that space, given that the investments theme is one of the key drivers of the economy and will continue to be for quite some time. I think there is a whole lot of work that is going on the railways front, on the power. Now thermal power is also coming back quite strongly. There's a move towards renewables, and then the urban infrastructure theme is also playing out quite strongly. And this is the first part of it. Of course, the private capex is yet to unfold in a big way. We are seeing some early signs of private capex beginning. So my belief is that for the next 3 to 5 years, there is a clear growth path for the entire space. Of course, the other opportunity of manufacturing for the world, for the larger companies across the world, being a sourcing base is always there for the Indian companies, given the the environment that is being provided with lower taxation, the incentives that have been given to these industries, etc. So that's the added advantage. So I think there is enough growth there for companies to take, which is why we are positive on this space.
How do you look at the small cap and the mid cap space with respect to capex? Because are you seeing many of these companies putting in more capex, and so the growth momentum for them would be much more in the near term or medium term for them?
So a lot of these are in the manufacturing space, and they have capacities. The last cycle, there was enough capacity that was created, and which is why you saw kind of decline or a contraction phase for a long period of time. From 2020 or 21, we've seen an improving trend in terms of that utilization, and as a country, we are now at, I think, 75-76% utilization levels. Further capex will take place as and when opportunities come and as and when companies or businesses reach high levels of utilization. So it's more case-to-case basis, I think. But generally, small caps and mid caps have been doing well given this environment of better growth. Interest rates have risen but have not really reached levels which are biting. Leverage in the portfolios are fairly low. Leverage in the company balance sheets are fairly low, and therefore everything is flowing, and taxation is also lower, so everything is flowing to the bottom line, and therefore the ROEs are getting better. So which is why there is outperformance from a large number of these companies.
Banks and financials, you've been bullish on them. Which segment of the banking and financial side is, we are more? Is it the mid cap and small cap, or the large caps that have been doing well?
So banking and financials, we've had a slightly lower weight. I would say, within banks, again, I think we've played some of the public sector banks, the top ones, a little more. NBFCs and finance space, in some portfolios, we've had a good exposure. We've been having that for the last few years. That's done well. So overall, if you see as banking and finance, I think we are maybe slightly underweight compared to the benchmark. I think in terms of margins, the net interest margins, the banking space has seen the best, and now it's on a declining trend with the fight for deposits, continuing. My belief is that is likely to continue for some more time before it peaks out, that pressure on margins, etc. Valuations, however, relatively compared to the rest of the market is cheap, but that's the consensus view. So I don't know how much is left to play, from the market.
Around what, 10-11% exposure?
Yes, I mean, so we are underweight the heavyweight index stocks, and we have got some of the public sector banks, and this is a space where mid and small caps we are a little wary of, because lending is something that is very easy to do, but getting back the money is tough. So you need to be in high quality institutions where the underwriting process is strong, and therefore we've not really gone very low in terms of market cap to identify companies in this space, but we've got some good quality financial, NBFC is also in the portfolios. It depends on which portfolio you're looking at, but yeah, we do have.
And consumer staples and consumer discretionary, that's something which people are a little divided on in that sense. Discretionary they are bullish on, but staples they are very cautious.
Yes, I think staples, of course, the valuations are high, but that's been a problem for long. I think growth has been subdued because the rural economy is not really performing as well. There are views that it is getting better, but there's still evidence yet to be seen on that. But I think the discretionary space, especially the high-end discretionary consumption, is really doing well. Our belief is that consumption as a theme is going to be a very powerful theme for the next decade or so for India, given that the per capita GDP is at about 2,200. We've crossed that $2,000 mark, and the expectation is by end of this decade we'll go to about $5,000 plus per capita GDP. That is likely to unleash a whole lot of discretionary consumption. And along with that, you have the under-penetration in multiple categories within consumption, and a shift from the unorganized market to the organized market. So in multiple segments within discretionary consumption, the unorganized market is very large, and slowly that is getting converted to the organized space. Some of these companies which are getting listed, if you take the last 2 years, 1.5 to 2 years data in terms of the IPOs, there are a number of companies which have got listed, number of new sectors that have got listed. Some of these are in that discretionary consumption space. Now they're getting to a scale, and that scale is coming because there is a shift from the unorganized to the organized sector. So market share gains, penetration getting better, per capita consumption going up, meaning higher spending by consumers, all should lead to a good performance from the consumption theme. Staples is separate. Staples, I think, is not a great place to be. It's a stable segment, high return segment. Return in the sense the ROCs, etc., are very high. Cash flows are very strong. You don't need cash to grow the business. So great place, that sense, but for generating returns and alpha, I'm not sure whether that's the place. Discretionary consumption is a more exciting space. I think for the next 10 years, there'll be multi-baggers to be made there.
Which are sectors where you can create alpha as of today? You spoke discretionary is one of them, but aside of discretionary, is there anything else? Yeah,
I think the more exciting space within manufacturing, where companies are getting into niche segments, taking the opportunities available from a global platform, taking advantage of government incentives. That is a space which is interesting. Some of that is also, like for example, electronics manufacturing. There are opportunities like that across the market where new sectors, new segments are evolving. In pharmaceuticals and intermediates, in chemicals and textiles, in multiple segments. Therefore, there are companies that are doing good work, and therefore alpha can be created in many of them. So I think the smaller sectors within the overall, theme of manufacturing, many of them have companies that are doing well, taking advantage of all what I said, and that's the space where you can generate alpha.